So here we go, the most popular video series that I do on the channel, which is the stocks I'm buying December 2023 edition, and it's the last one of the year. Well, technically I'll record January's in December, but the last actual month of this year we're going to be talking about the stocks that I'm going to be buying. Now obviously I bought all these stocks from the 1st of November to the 1st of December, and everything that I bought or sold will be on this video. I've done this series for many years, talking about what I'm buying, what I'm selling. During the whole bear market in 2022, I was still here. So many investors quit, so many YouTubers quit. I stayed on here, kept on filming from this whiteboard, telling you what I'm buying, what I'm selling, and obviously the rewards are coming in 2023, and hopefully they continue in 2024. So there you go. Hopefully these stocks as well do very well, and I'll talk about them for about 3 or 4 minutes, talking about why I'm potentially buying those stocks. But if you want any more detail about any of the stocks mentioned, I've probably got a full video on them somewhere on the YouTube channel. Enough of blabbering on, guys, let's get started. And as always, if you do want to see some more exclusive videos from me, join the Patreon, £5 a month. On there you get 2 exclusive videos a week. Last week there was actually more than 2 exclusive videos on the Patreon. You also get to know my live buy and sell alerts in real time on there, as well as that there's a Discord with 500 members on to talk about stocks, including me. That's the best place to get hold of me. And for £5 a month, it's not that bad at all. It's the price of a pint, and considering everything you get on there, it's pretty good if I say so myself. And also it's probably why it's the highest Patreon to YouTube subscribers on the whole stock market scene at the moment. As well as that, get some free shares, trading to them too, link in the description. Join from there, get a free share worth up to £100. That's personally the broker that I use. But let's get stuck onto these stocks. So first of all, Inmode. I did start buying some Inmode through the last couple of weeks. Obviously you probably saw the whole drop because of the whole Israel and Hamas and Palestine situation. I won't touch on that too much today, but obviously being in a company based in Israel, that did affect the share price. As well as that, they came out with some financials that I think maybe made a few people worry. We'll get onto that in a little bit, but obviously it's stock that I've owned for over 3 years now. I started buying this in 2020. At the peak, I was actually up on this stock over 400%, and I was actually selling this stock for 400% profit. Thought I'd never see the days. I thought we'd see a bit of a check on, fair price check on the share price. Thought it might be in about 30-40% pullback. I thought, a bit of valuations maybe a little bit stretched here. Did not think we'd go to the sort of levels that we're at back in 2020, and that's what happened. So for me, if I kept my shares that I had in June time, I'd probably still actually be up on the position where I did first start buying, but obviously I keep averaging up on this position. So for me, I'm actually about break even on this position now, around about 10 times earnings as well. Now obviously, if you don't know what Inmode are, they are a bit of a appearance cosmetic company, and they make these machines, one of the machines being Morpheus 8. I wonder if I can click back here. I can show you one of the machines very quickly if my internet is going to be very quick. So these are kind of what the machines look like, and when you get some of the treatments from this machine, if I go back on here, you can see from the Morpheus 8, which is the newest one I believe, you can see a before photo and after photo. Obviously you can see around the neck here, and people being a bit more conscious around their appearance, going, I don't want to go under the knife. These big treatments where you have to get cut open under the knife, get put to sleep, these treatments you go in on the same day, come out for the same day, don't have all that aggro with it. And you can see here the change in the neck appearance here from this example. Another one here that you can see is a one for skin treatment, so they can be sunspots, age spots, freckles, and you can see the difference here on a before and after photo, as you can see here. So they have a lot of these machines and these treatments here. You can see why they're very popular treatments that get taken up, and also very good reviews from the doctors that use them. Now the share price itself is obviously down, as we say, because they are an Israel-based company, and a few people are worried about the war situation that's going on there. That seems to be calming down a little bit, and maybe that's actually the cause of why the share price has started to rally a little bit more in the last couple of days. But I think the bigger thing is the financial results from the company. The first time we've seen Inmode have a wobble. We've seen this company really be EPS and revenue for many years. If you follow this company for a long time, they're normally beating the financials by massive. First time they had a bit of wobble. It's frustrating that the share price has reacted like this off a bit of a financial wobble, because during this time frame we saw the stock be, during this period alone, there was 6-7 quarters of absolute amazing beats, and we saw no reflection on the share price, which is frustrating. And then the first one, there's a bit of a wobble. It goes down so much, it's stupid, but it is what it is. We've got to see if this is an opportunity for a great company at low prices. Now they came out, and you can see there was a little bit of a miss on EPS, a little bit miss on a revenue point of view. and they did downgrade the guidance a little bit on that. Obviously, this was from their recent financial results, which is the weaker period because this is the summer period. No one wants to get treatments in summer because everybody's too busy going away. So hopefully we see the rebound in the next coming few quarters. The main reason that Inmode said that they're seeing the weaker earnings is because the cost of financing has gone up. Doctors are, trying to get the machines that we talked about, and they're not cheap. A lot of them do through financing, and Inmode talked about, the financing issues that they've had, how long it takes to get the financing, the higher interest rates. So it is a little bit sensitive to these interest rates at the moment, which I think is really a short-term issue. So they also recently talked about how they're potentially going to get around that with their offering their own financing, for example. So not that much of an issue, I believe, in the long term for Inmode. We've seen before over the last few years how they financially normally smash it. So yeah, look at the growth of the company, revenue growth, profit wise. Obviously we talk about the company at the same sort of valuation where it was in 2020, for example. That company was doing, if we just go to June time 2020, we can see they were doing 158 million in revenue. They now do nearly 500 million. From a profit point of view, they did 50 million in profit. They're now doing 180 million. So it just doesn't make sense from that sort of valuation point of view, even with the current issues that are going on at the moment. Financial wise, unbelievable. Probably one of the best balance sheets of a company that I own. No debt on there. They sit currently on 675 million of cash. Now you might say, well, that's nearly a third of the market cap. Why don't they use that cash up? Well, they've actually been looking for an acquisition. They recently came out and said they have approached 2 companies to buy them. Both of them was rejected. They are currently looking at another 2 companies, so they don't do a cash buyback because they think they can do an M&A, which they think would be better value to the shareholders. They also said they believe last time they did a share buyback, it did not work out for the business and it showed no improvement on the share price. I'll let you guys debate if you think that's true or not, but yeah, obviously, at least we know they are somewhere with the cash position anyway. So yeah, I think this is a good opportunity at 10 times earnings for a company that has a very good track record, a good balance sheet, and out of a higher interest rate environment should do very well. The next one is SoFi. So SoFi, I've said for a long time, $5 to $6 I do really like. We may even see it, to be fair, get into the $4 range, but I think $4 range would be kind of a bit like 2022 prices. So it could happen, but it would be very extreme for us to get there. So we'll see what happens there. SoFi, a finance business, a fintech business, and offers many products. Actually, a bank now. They've actually got the bank license as well. And you can see it's basically the one-stop or one-shop place for all of your finance products. So you can get the personal loans, for example, from here, banking, credit scores, mortgage loans, student loan refinancing, which is actually what the main business was for many years. But then student loans refinancing was obviously paused. It's coming back now. So this company was really based on that. It got taken away from the company and they've still smashed it. And then that's going to come back in the next few months, which is obviously going to lead to another surge in the company's business. You got the investing part, private student loans, credit cards, insurance, travels. So you can see here, basically, what they're trying to do is be that disruptor in the space where you can get all the best products from the one place, and that's what they're trying to do, is get everyone onto the platform using SoFi and then hopefully cross-sell all of these products towards you. So not only when you go to a bank, for example, a bank, you might only be able to get a certain amount of the certain products or what have you. So if you look at the members are growing rapidly, as you can see here. And the great thing is the products. Obviously, they're offering more products and people using more products as well. So eventually, the member growth will slow down, but their hope is that you will go and use more products from this platform. And you can see here that has translated into the revenue growth that we've seen here at the moment. And you can see here from an EBITDA point of view, that EBITDA has been ramping up as well. Like I said, another positive coming back is student loan repayments. This will be a big part of the company that obviously will help them with their financial point of view. We can see the revenue growth has been very good. I think the revenue growth will probably be a bit higher than what analysts are expecting, but we're still expecting good growth from the business. And you can see here from an earnings point of view, they are going to do Q4 GAAP profitable, and we are expecting a full year profitable in 2024 and hopefully in 2025. You can see here in 2025 numbers, if we go around about a forward P basis, it's around about 30-ish times earnings, which I don't think is that bad at all for a company like this, a fintech platform. And you guys know I like my fintech platforms. Financial wise, it is pretty good as well. Obviously, it's a finance company, so with the loan side of it, you are going to have a certain amount of debt on that balance sheet. But when you look at the cash balance, I mean, they sit on at the moment 3 billion-ish of cash, which is about half the market cap, which is obviously really good. The main thing that people have been trying to make an issue out is the insider selling. I don't mind the insider selling really, because a lot of people inside a company like this will get paid most of their wages through stock-based compensation. So there is going to be some form of selling in here. The big thing I'm looking at is like the CEO, Anthony Noto. And if you look at what he's doing at the moment, he's just buying and buying shares. You know, on the 21st, he picked up some shares. On the 9th, he picked up some shares. If you go back to the 15th of May, he picked up some shares. So he really likes the price at the moment. He keeps buying in that kind of $4 range, $5 range, $6 range. So yeah, if he's buying, that says a lot to me that if he's buying a lot of shares at the moment, that we can be okay with this one. So yeah, I think that when you look at the growth and the profit these guys are going to drive up in the next few years, it's going to be a really good position, I think, in SoFi. Next one is JD.com. So I have been buying a few JD.com shares. I first became a shareholder of JD.com in 2018. Same again, it was a stock that I was up over 400% on during the whole boom we had in 2021. Never thought I'd buy JD.com shares again, but now it's gone back down to the levels it was in kind of 2018-ish, as you see here. So nothing at all for the progress the company has made. Obviously, China at the moment is going through a few situations, but I think in the long term, this company as the king of e-commerce in China will obviously do very well. As well as that, people forget it's got its logistic business, it's got its healthcare business on top that you're picking up with this business. Basically, people get this mixed up. Basically, JD.com is the Amazon of China. People will say it's Alibaba. The reason why they say it's Alibaba is because of all the products Alibaba use, referring to Amazon and all the kind of products they have. Whereas JD.com, really, Alibaba doesn't actually have the products and ship them out. JD.com does that, so that's why it's more like Amazon, the actual website, not the company point of view. And basically, this is where a lot of people come to order anything. In fact, a lot of companies will actually sell through JD.com. So an example for that is like Nike. If I search in Nike on, I'm hoping this is going to work. If I search Nike on JD.com, for example, and hopefully it picks my English up, it will take me to the Nike official store. So it's basically got me there, but you can see here, like they've got all the Nike products here selling through it, and all the Adidas products like there, for example. So you can see here, like this is where a lot of the as well brands come to sell through the JD.com site as well. Recent earnings I thought were pretty good. EPS was good, profit ramp up was very good, revenue could have been a little bit better, but obviously it was a beat. If you go through the earnings, I thought they were pretty solid. Hopefully the revenue keeps increasing, around about 10% a year is what we're wanting, and hopefully the profit ramp up as well keeps happening. Good balance sheet as well. The company has very low debt to equity. They sit on a decent amount of cash, as you can see here, and they did pay a one-off dividend, which I don't think they're going to carry on doing going forward, but obviously something to kind of factor in there. The next one is PayPal. So I'd buy once again more PayPal. I'm not buying as aggressive with PayPal, but I am still nibbling every so often on it. $55 has had a bit of a run up in the last kind of couple of month here, but still at $55, I think that's really attractive, because I think this is going to be at least $100 plus stock in the next 5 years. Realistically, I think it'll be more than that. 16 times earnings. Actually, when you look on a forward basis now, it's a 9 times earnings. 9 times earnings for PayPal. It's absolutely crazy. We've got the new CEO coming in as well, Alex Chris. So hopefully he obviously translates the company into the next stage of a good future. And you know, when you talk about PayPal, I mean, you talk about a company with this track record of growing the business on, I'm going to get rid of free cash flow, on a revenue base and a profit base. It's just absolutely insane. And if you look at the future growth as well, you know, we're still going to be growing at like 10+% a year. And then from a profit point of view, we're still going to be growing hopefully at the bottom line of 10+% a year. Free cash flow, hopefully we're throwing off around about 6.7 billion in free cash flow. That's less than 10 times free cash flow. This is the lowest valuation that PayPal has ever been at, and the company is getting treated like it's a dead company. I mean, you can easily say this should be trading at a market average valuation of 20 times earnings. And you're already in a year's time getting double the share price from here, not factoring that you have like Visa at like 30 times earnings, and they're roughly growing at sort of the same numbers as well, which is just absolutely crazy. Balance sheet wise as well, you know, really solid balance sheet. 53% debt to equity. They're throwing off that much cash as well. They're buying back a ton of shares. They're buying back, I think it was last time, 6 billion of stock. You know, you're talking that they're going to be buying back a big chunk of the market cap as well. So, You guys know I've talked about this one for a while. I really like PayPal at these sort of levels at the moment. And the next stock on this list is a stock that I'm actually going to keep secret. So this is a brand new stock that I bought. I only bought this a few days ago. Now, because I only bought this stock a few days ago, I thought it was a bit unfair to say I bought a new stock on the Patreon, that obviously a lot of those guys sign up for that exclusivity and then reveal it on YouTube a few days later. So I thought it was a bit unfair on them guys to tell you guys that are not on there straight away. So there was that kind of reason why I'm not revealing what this stock is and this new stock that I bought. The other thing that I'm also being a bit more conscious about is that going forward in 2024, I'm having a bit of a rethink on what I do going forward, because obviously through the last 2022, 2021, 2022, I used to share my stocks that I'm buying and selling, which I'm doing now every month on YouTube, which I was happy to do because it kind of showed that this is what I'm doing in the bear market, this is what I'm buying, and then if they work out, then obviously you can judge me as an investor, and if they don't work out, then you can say, well, he's a bad investor. And obviously, as we've seen, I've done very well in the market this year, and hopefully, as those stocks continue in the next few years, they carry on doing very well. So I think I've kind of proven in the scene through a bear market on the really big times as what tests you as an investor, that obviously I can do very well through those time frames. Now that I've kind of proven, I'm not sure how much I want to kind of give all this information out for free. I want to kind of reward the people that support the channel a little bit more and maybe give them more of the information. So I'm kind of like trying to find the balancing act of what is best to share with YouTube and what's the best to share with Patreon. And the other thing as well is, like, you got to remember, like in 2022, I took a lot of heat through the stock market of buying the same stocks that were down, and now obviously they're up. Obviously, you know, when the stock market's down low, you're the worst investor ever. Now when the stock market goes up, you're the best investor ever. And you know, I've kind of proven to do quite well through that bear market and stick it out the other side. And you know, there's a lot of people that have suddenly started to go a little bit quiet because obviously I've done very well in the stock market, and I don't want them getting the information for free after all the stick that I had to take in 2022. So there's part of me thinking, I don't want them to get my stock tips for free after the year that we've had. You know, I want to reward the people that support the channel more, which is the guys on the Patreon, and I want to give them all the best information. So there's a bit of a balancing act that I'm trying to think out going in 2024, and yeah, so this is a new position, and I'm not exactly sure what I'm going to do with this position, if I am going to reveal it a little bit later on, or if I am going forward going to be a little bit more selective on what I do share on these videos. But I thought I'd let you know I have bought a new stock, I have bought a new position, but I am not revealing that one today. The next one is Walgreens. So you guys know I've been buying a little bit more shares in Walgreens in the last couple of months, and this is a bit of a turnaround play. So the company has been going through a bit of a bad patch recently through managing costs, and it got to the point where I thought, you know what, this is worth me buying up Walgreens. It's a dividend king, pays a massive dividend yield at 9%. Questions whether or not that dividend will be still paid out at that sort of yield going forward, but something to bear in mind. And if you look at the share price, it's been a really tough time since 2016, and I've got to the point of view now in the last kind of couple of months where I go, you know what, I can justify the valuation now that I buy this turnaround play and see if they can get it to the other side. Walgreens, obviously most of you guys will know Walgreens. I think that the big thing is Walgreens are going to be around for many years because it's just so handy going to those locations. Also, you think about pickup and delivery, and obviously they've been battling with the likes of Amazon for many years in e-commerce. I think it's kind of got to a bit more of a level platform now where Walgreens have caught up to them a little bit. So they've got to utilise a lot of these physical locations a lot more as well. And I think that if they can do that and manage the costs, the company will do very well. They've brought a new CEO in. The last CEO didn't go down that well. So hopefully as well, the new CEO can see a good direction for the business going forward. The last earnings, I didn't think were too bad. If you look at the EPS side of it, they did miss slightly. Revenue though did come in strong once again. They did turn the outlook down a little bit at the moment. They're saying a lot of it is they did expect they had a higher tax rate, and they did expect the CV contribution to be a little bit higher than what has happened this year. If you do look at the recent costs though, you know, they basically said that where the big thing is that they've still got good growth. The thing is managing the costs, and as long as they can manage the costs, the company will do very well. And you can see that they said that they have included planned cost reductions of at least 1 billion and lowered capital expenditures of approximately 600 million. And obviously there is where you start generating hopefully good amounts of profitability. And if you look at the company here, as long as they can grow a couple of percent a year going forward, obviously they're growing more than that at the moment, but a couple of percent a year, start driving up that profitability, because they are currently loss making at the moment. And obviously analysts are forecasting 1.9 billion profitability up to 2.4 billion the year after. Obviously that will put you down at a nice valuation at the moment, and hopefully they can generate enough profitability at the end of the day. As long as the share price stays flat and does nothing, I mean, this is a big thing with this investment that that is something to factor in. The share price can stay roughly around $20 as long as they make enough profitability to keep up a very high dividend yield. Obviously 9% might not be consistent at the moment. They might have to peel that back a bit to like 7%ish, but even then I'll be getting the average S&P's return just from this investment alone. So yeah, we'll see what happens there with Walgreens as well. And the last bit to this video is the sells. I did sell 2 stocks in the month of November. Most of you probably aware, I made the video about it. I did sell Gang, investment that did not work out. I had to take a loss on this one. I took around about an 80% loss on Gang, which is disappointing. Unfortunately, it seems like this stock was a little bit mismanaged. Looks like the costs were not controlled enough. Seems like their employees were very much overpaid as well, and as well as that, contracts just didn't turn out on what we were hoping. They were winning big contracts, but the contracts they were winning, the companies they were providing the service for, were not winning. So the likes of like signing on WinBet and Churchill Downs we thought would do very well. Unfortunately, the likes of DraftKings took major amounts of share, and it ended up with WinBet closing down most of their services, and the likes of Churchill Downs closing down most of the services, and then Gang struggled. And then just to top it off, they lost they had to redo a contract with one of their major clients, and they were able to get Gang to get a lot cheaper money off them for it, which then totally wiped it out really. So yeah, unfortunately it seems like to be a bit of a mismanaged company, and management always make or break investments, and unfortunately they broke this investment for me, which then goes to the opposite stock, which was one of the reasons why this stock struggled, which was the King. DraftKings obviously smashed the online market space for sports betting, got a good chunk of the market share, and has performed amazing. One of my best performing companies this year. Obviously I beat in the market this year, and one of the reasons why I beat in the market this year is because of this guy. When your largest position is up 250% year to date, you should do very well, and that's what's happened. So this stock has done amazing for me. The only issue is now is that it's done that well, and I was buying so heavy in 2022 when it went to absolutely ridiculous levels of $11. This stock has come to like 25-30% of my US portfolio, which is way too much, because as much as I love DraftKings, I can't justify a single position being that much of a position, because if anything did go wrong, losing 30% of your wealth would be awful. So I want to still keep this in my largest position. I've just got to rebalance the portfolio slightly. So yeah, I did sell 10% of my position, trimmed my position in DraftKings, and that obviously freed a lot of cash up as well. But it's just more from a rebalancing the portfolio point of view. And that 10% that I did take out of DraftKings did then go into buying the new stock that obviously is a little bit of a mystery at the moment. So that was the actual move that I did last week. So I'm going to keep that one a little bit secret, like I said. So those are the stocks that I have bought and sold during November. Hope you enjoyed the video. If you could, hit the like button. If you're new around here, subscribe, and I'll see you in a bit.